We're going live. No separate meeting. Calling to order the special meeting of Monday, April 20th, 2026 at 5:00 p.m.
Sorry, I think we're sorry.
Someone to adopt the agenda, please. Councillor Erickson. All those in favor? And that is carried. The delegation presentations up. We have the Matrix Group LLP presentation of 2025 audited financial statements with Craig Pater, CPA Senior Manager.
I'm just going to share the screen so that anyone watching live can also see the presentation, and then it'll be ready. If you prefer to control it, you can use the mouse or the arrow.
Okay, as previously mentioned, I'm Craig Pater. I'm a senior manager at Metrics Group, and I'm going to talk about the audit process and results for the Town of Peace River for 2025. Oh, that's not the PowerPoint, that's the audit findings report. I just realized that, sorry.
Can we maybe recess for 2 minutes to get that PowerPoint?
Okay, we can recess.
Yeah. Do you have
Bring back on.
And we are back for the presentation.
That's not what's posted on.
Seen this, yeah. There we go.
Okay, sorry for the delay. Again, I'm Craig Pater. I'm Senior Manager at Metrics Group, and I'll be talking about the 2025 audit of the town of Peace River. So to just get started, an audit overview. Not sure how familiar everyone is with an audit, but an audit is an independent review of financial information to check whether it's accurate, complete, and fairly presented, the financial statements. Audits provide users of the financial statements a greater confidence that they can rely on the financial statements for decisions making. So for the users for the town would be yourself, council and mayor, any funding bodies such as the provincial government, the look for long-term debt for the provincial government for that aspect too, as well as local municipalities for your ICF agreements. So we ensure that the financial statements are presented fairly by assessing in all material respects that they are done in accordance with public sector accounting standards. We are independent from the municipality, from council, from management. We seek to provide a reasonable assurance, not absolute assurance. This might be a misunderstanding sometimes with audits where we do not audit every single transaction. We instead look at methodologies, using professional judgment as well to ensure we're testing the correct amount of items as well as different items, just so management does not come too familiar with what we're asking for constantly. Like to keep throwing curveballs at them just so they're not expecting fastballs all the time. We provide an opinion on the financial statements and the accompanying notes and schedules. So we are pleased to issue a clean or unmodified audit opinion for the consolidated financial statements for the year ended December 31st, 2025. In previous years, the financial statements have been qualified due to inventory, but we are able to come, inventory is kind of a funny process where you have to think about it a year in advance because you have to make sure your opening numbers are accurate for your ending numbers to be accurate. So we came out in January of 2025 to do an inventory count, and then January 2026 to do an inventory count. The 2025 is to make sure that the December 31st, 2024 balances were correct, so that your January 1st, 2025 balances opening are correct as well. So responsibilities. Management is responsible for the financial statements. While we prepare them, we do get management to sign off on the management's responsibility for financial reporting, because council signs the financial statements, our firm signs the financial statements. Management's the third element of that to ensure that everyone's in agreement of the financial statements. So as auditors, we complete our responsibilities by identifying and assessing risks of material misstatement. We design and perform procedures in response to the risks identified. So this includes control testing, substantive testing, reasonabilities, vouching to agreements. We review council meeting minutes. This is all done to ensure that we obtain sufficient and appropriate audit evidence. And this is completed using the procedures previously discussed. So we have to make sure, that's why we have methodologies to make sure that if accounts receivable is a certain balance and there's a certain amount of transactions, that we are testing enough accounts receivable to be satisfied with the results of the tests. We also obtain understanding of internal controls that are relevant to the audit. So we review what the intended procedures were and test them to make sure that they're effective. So signatures on invoices, timesheets being approved, payroll registers being approved, that sort of stuff. We evaluate the appropriateness of accounting policies. We believe that the town's policies are reasonable for the financial statements, and we evaluate the reasonableness of estimates. So for the town, the estimates are the valuation of inventory, which we've kind of talked about already. Collectability of accounts receivable, that's for both trade and for taxes. So we inquire with management to make sure that there's outstanding accounts, that there's either a payment plan in place or that there's constant communication with overdue accounts to make sure that they are collectible. We review the future cash outflows associated with accounts or asset retirement obligations. So that was a new standard a couple of years ago where It's basically a big one to think about would be asbestos in a building where the accounting standards looked at items like that and realized, hey, there's going to be an additional cost to remediate these assets, even though they're an asset for you. There's going to be costs associated if you ever dispose of these assets. So we have to record a liability for those. The estimated useful life of tangible capital assets, so that's amortization. So, if a pickup truck's in the last 10 years, we review to make sure that's reasonable and that you guys aren't routinely getting rid of pickup trucks at 7 years, or maybe you're keeping them to 15, where we should be saying, hey, you need to increase your estimated useful life because we want to be as accurate as possible for the amortization and the estimated useful life of those assets. And the final estimate is any accrued liabilities. So there's a payroll accrual at the end of the year, just because the dates of when your payroll periods cut off are clean December 31st. So we have to make sure that the amount of the payroll accrual is reasonable. We also conclude on the appropriateness of using the going concern basis of accounting. There's no going concern issue at the town. You guys have a healthy cash balance and a good amount of reserves, but we still have to make sure that there is a going, that you guys will continue to operate as a going concern. We evaluate the overall presentation, structure, and content of the financial statements, including disclosures. And again, we believe that these present fairly. And because you guys are consolidated not only with the library board, but with the waste company, we have to obtain sufficient and appropriate audit evidence regarding the financial information of those entities because they are consolidated into the town. So for the library board, it's easy. We are the auditors, so we're pretty certain of our numbers. For the waste company, we have to communicate with the other auditors of that entity, review their working papers. We send them a big package. They have to sign off, say that they're doing their due diligence as well. So we have reliance on their numbers too. So for the audit results, for finalizing the audit, our standard completion procedures are completing our subsequent event inquiries, which I finished up this morning with Roxanne, obtains the signed management representation letter, completing our required communication to council, so that is this meeting, and then obtaining evidence of council approval of the financial statements, which we are hoping will be at the end of this meeting. As far as accounting policies and estimates, there are no changes in policies or estimates that impacted the financial statements. And after completing the procedures for the audit, there were no significant findings or issues noted. Like I said, we're having a clean, unmodified audit opinion. There was no management letter. Overall, it was a good audit year, and the financial statements show that. So the significant audit risks, management override of controls is the first significant audit risk. Management is in a unique position as they are able to override controls and make journal entries to hide potentially fraudulent transactions. Revenue recognition is a significant audit risk. We just want to make sure that the obligations of any funding that has restrictions the obligations have been met, so we can recognize the funding. Receivable balances, we want to make sure that they relate to 2025 and as well are collectible, because you can have a huge receivable, but if you're never going to get that money, it doesn't really matter at the end of the day. Tangible capital assets, it's a significant balance for the town, and we want to ensure that the additions are capital in nature and that no capital items have been expensed. And again, that the estimated useful life is reasonable. Inventory for consumption. Again, that's a subject to management estimate. So there's always a higher risk related to those. We performed an inventory count January this year and January last year. So we randomly choose inventory items that are on a listing to make sure that it says if you have 5 WD-40 cans, that there's 5 WD-40 cans in the shelf. We also review unit costs of certain items just to make sure that the WD-40 isn't at $100 a can, that it's at $5 or $10 depending on the size, to make sure it's reasonable. And then the last significant audit risk is asset retirement obligations. So it's a significant liability. We need to ensure that there's no management bias related to the future cash outflows, because that's how the asset retirement obligation is calculated. So for all the significant audit risks, there were no significant findings. Everything looked good. We had no issues with those, so that's positive. Now to the fun stuff, the financial results. So this is the consolidated, you can't really see with the title, it's the consolidated statement of financial position. This will be the third page, I believe it is, on the financial statements right after the auditor's report. This is the first page up. So starting at the top, you have financial assets. Financial assets, those are assets that give the municipality a right to receive cash or another financial asset from another party. They're just a little bit more liquid. So that's why we put them at the top, because those are one of the more important aspects of the financial statements. So we have the financial assets on top. We'll see that the first item, this cash and temporary investments, those went from 16.15 million to 22 million. So an increase of roughly 6.2 million. This was due to an annual surplus of 3.6 million plus the non-cash amortization expense of 7.3, less roughly 4.8 million of tangible capital asset additions. Going down 2 lines, we'll see trade and other receivables went from 7.6 million to just over 6 million. This is due to lower grant receivables from the province. Prior year, there was a $3.5 million small communities grant that was received, or I guess receivable, that there was no such grant in the current year. But that was partially offset by higher local government transfers. There was $800,000 from Northern Sunrise County related to a hot tub, and almost 1.2 million from MD of Opportunity related to wildfire evacuation costs that occurred in the MD that the town supported with. So the town incurred costs and then they just turned around and billed those back to the MD. So it's receivable at year end just because the money has not been collected. As at December 31st, it was collected in the first bit of 2026. So looking at financial assets, overall, they increased roughly $5.7 million, or 21%, from 26.8 million to 32.5. That's a really good growth. Anytime you can increase your financial assets 20%, that's a very good sign of how the year went. So after the financial assets, we'll look at the liabilities here. Overall, your liabilities only decreased $300,000, so they are very comparable year over year. The biggest change was the accounts payable and accrued liabilities, and that increased from 3.7 million to 4.8 million, almost 4.9 million, due to additional tangible capital asset projects that were payable at year end. I know there was a provincial sidewalk portion that was accrued for 800 and some $1,000, and then the RCMP policing costs payable was also recorded as of December 31st, 2025. So that resulted in the accounts payable increase, but your long-term debt decrease, and we'll get into that further. So overall, when we look at your financial assets, less your liabilities, the financial assets less your liabilities, that's either a financial assets overall or net financial debt. So in 2025, you guys had financial assets of just over $1 million. In 2024, you had net financial debt of just about 5 million. So year over year, your assets have increased $6 million. That's a tremendous increase. And I'll dive into that more in the next few slides. But overall, that almost $6 million swing is very positive to see. That's a result of your assets going up, your liabilities going down. At the bottom of the page, you'll see the non-financial assets. So non-financial assets are not financial in nature, and they're used to deliver services rather than to generate cash flows directly. Those provide value through use as opposed to value by getting cash. So it's your tangible capital assets, your inventory for consumption. So that's the inventory that the town is going to use for their own purposes. So if you buy, grater blades, so you don't have to run to the store every time, you just hold them on hand when you need to replace grater blades. Same with the WD-40 as previously talked about. And then your prepaid expenses is the last one. So that's typically insurance, right? Insurance doesn't always necessarily run the calendar year. It'll go from November to November. So in December, you prepay your insurance for the next fiscal year. That's what your prepaid expenses are. Number at the bottom is accumulated surplus. So that's taking your net financial assets plus your non-financial assets to get your accumulated surplus of $132 million. That increased just over $3 million from last year. And again, that's a healthy increase. And I will talk about that more in the upcoming slides. Okay, taxes and grants in place of taxes receivable. So this is the property tax assessments that are receivable to the town as of December 31st, 2025. Your current taxes decreased slightly, which is positive to see. That means more people are paying in a timelier manner that are at least current with their taxes. Unfortunately, the taxes in arrears did increase from just over 1 million to just over 1.3 million. In looking at that, so that was a $260,000 increase. The majority is from 7 tax rolls or 5 entities. They owe 1.1 million from that. So the number looks a little worse than it does, or than it actually is, because it's those 7 tax rolls that just haven't paid taxes the past few years. So the current year taxes they haven't paid, and then the interest and penalties keeps getting accumulated on. So it's not as troubling as it looks, where the vast majority of your residents are paying your taxes and paying them on time. It's just a handful of groups, or a handful of entities, which we see in other municipalities that are slow to pay, and then that results in a higher taxes and arrears. And as a result, the allowance for doubtful accounts went from just over 1.1 million to over 1.4 million. Again, that was a $288,000 increase. So that basically, the increase of your allowance for doubtful accounts was due to the increase in your tax and arrears. Just as things have been aged longer, there's a lower chance people are going to pay them, right? Where if they haven't paid their taxes in 5 years, we don't think that they're going to necessarily come in Jan 1st with a big check saying, hey, I owe you guys a whole bunch of money. So we like to include an allowance just to show what the net receivables are. And overall, your net receivables decreased slightly from 606,000 to 520. Again, majority of that was because your current taxes decreased. Take a look at your deferred revenue now. So deferred revenue is funding that the town has received, but the related obligations have not been met. So therefore, the revenue has not been recognized yet. That's why we call it deferred. Your majority of your deferred revenue balance is your local government fiscal framework. The additions in the current year are 1.2 million. That is the allocation from the province, the 2025 funding. We were able to recognize almost $50,000 of that. Related to some paving projects. So this is just money that's going to be spent in the future on various capital projects as management and yourself deem fit. The Alberta Community Resilience Program, the additions in that one was just the interest allocated. So management needs to allocate portion of the interest on the money received that isn't deferred to the deferred revenue, just because technically you have received the money and you're earning interest on it. So instead of the town getting that unrestricted, the grant's conditions are that you have to allocate the interest earned on that money back to the grant, because they know, hey, you earned $7,900 on our money. You should be putting that towards the project, because realistically, you should be spending all of this money anyways. The MSI Municipal Sustainability Initiative funding, that program has since ended. So that money will be spent shortly, or else it'll have to be returned. I know there's capital projects coming down the line to recognize that money, because you don't want to have to pay back grant money. You want to be able to use that for various capital projects. Overall, your deferred revenue went from 3.5 million to 4.5 million. Just more money came in than that was spent. But again, this will be money that's spent in the future on various projects. Not a bad thing to have deferred revenue increase. It's just sometimes due to timing, especially I know past few years there's been fires, and it sounds like there could always be floods just based off of how the river breaks up. So we are expecting that money to be spent in the future. Looking at your long-term debt. So this is the borrowings from the town. Your long-term debt decreased from just over 20 million to just over 18 million. So it decreased roughly $2 million. Majority of this debt is from the province. So 18 million is from the province out of your almost $18.4 million balance. The other portion is from the County of Northern Lights for $323,000. And that's actually interest-free. Us as accountants, we have to calculate to see if there's a potential benefit related to having an interest-free loan. There is, but it's so small that we don't even have to acknowledge it, because technically you guys are getting a below market loan from a neighboring municipality. but that's okay. That's a positive thing. So the current portion of long-term debt, again, is just over $2 million. So long-term debt has decreased year over year, which is good. You guys haven't taken out any new borrowings and you've increased your cash, which is nice to see. The long-term debts mature between 2026 and 2050, and the interest rates are from 1.416% to 5.096%. Related to long-term debt is the debt limits. So the red bar that you see is the amount that is being utilized by the town. Green is what the actual limit is and how much the town could use. So for the total debt, the top bar, that is based off of 1.5 times the operating revenue of the town. And the debt servicing limit, the bottom bar, is based off of 0.25 times the operating revenue. So these amounts are subject to fluctuation based off of the operating revenue. So you want to make sure you're not very tight up against these limits, because if revenues decrease for some reason, I mean, I'm sure COVID year, revenues probably decreased, right? Things happen that are out of your guys' controls. So you don't want to be right tight up against your debt limits and then have it where next year you're offside on these and have a worse financial position. So the fact that you guys have utilized 18.5 million of your debt out of a possible 53 million is good to see. We want to see those well within those thresholds where you have a lot of room, because you never know what tomorrow's gonna bring. So you want to make sure that at least you can take out debt if you need to, but you also don't want to have your backs up against the wall by having so much debt that it's prohibitive. Take a look at tangible capital assets now. So these are the items that last, have a significant estimated useful life for the town. So your buildings, your land, your engineered structures, machinery and equipment, and vehicles. So your land and land improvements, there's an increase of $586,000 of additions just due to land purchase related to a sewer project, and some yard lighting and some fencing. The buildings, there was a brake tank installed for the boiler at the arena. Engineered structures, again, the sewer project and some paving. Machinery and equipment, there was radios, e-bikes, wastewater treatment plant, second clarifier added, and then the winter display ornaments. Vehicles, the community peace officer, there was a Tahoe purchased, a Dodge Charger, and then some lease buyouts. And then your construction in progress, your last line there of $2 million of additions. There was the hot tub replacement, Main Street concrete repair, town hall building renovations. And of that $2 million, well, I guess 2.5 million for construction based off the additions. $1 million of that was put into use. So it went from being construction in process to actual in use, advertised, used by the town. So that's good to see. The fourth column there, amortization. So that is the annual amount of usage of the assets by the town. So when you purchase tangible capital assets, it's not expensed, it's put as a non-financial asset, and you're going to expense it basically over a portion of time based off of what management thinks is reasonable. So the amortization, it's a non-cash expense. It's just basically accounting transaction to make sure that you are aware that $7.3 million of your tangible capital assets were used in 2025 and will eventually need to be replaced. We're not saying that it needs to be replaced tomorrow. It's just that eventually you're going to have to replace your tangible capital assets. So your amortization is kind of a good identifier of how much you're actually using of tangible capital assets a year. Your accumulated surplus, as we talked about previously, so your unrestricted surplus went from almost 2.6 million to just about 5.2 million. So that's a $2.6 million increase. So that's money that can be spent. It's not in a restricted surplus. It's just kind of your collection, kind of like a checking account for a person, right? Where it's ready on hand. You don't really need a reason to spend it. You don't want to just spend it just to, but it's nice to have that sort of money in your pocket. Your restricted surplus went from 16.6 to 18 million. So that's kind of more of your long-term strategic planning where, those are for kind of your rainy day fund where, future tangible capital asset projects may, be funded from that. Any unusual or one-time items that, the town wasn't expecting may have to be used from that. So it's okay to dip into, but year over year, we want to see it increase, and we have, so that's good. Then the last item, the big number, equity and tangible capital assets, that basically remained flat year over year. So that is your, tangible capital assets, less any related debt, asset retirement obligations, basically any liability that you have on your tangible capital assets. So an easy way to think about it would be your house. If your house is worth $400,000, but you have $100,000 mortgage on it, your equity in your house is $300,000. Kind of the same thing for this, where the town has a cost of, tangible capital assets of $130-ish million. But the equity you guys have it in is 109 million because you have 20 some million of debt and you have to pay your asset retirement obligations because we believe that if you have to retire all of your assets, those obligations would have to be settled. So that's the balance sheet. Now we're going to go more towards the income statement. So this is more of a, this is the operating revenue. So this is what the town brought in normal operations, during 2025. So overall, your operating revenue went from just shy of 34 million to 35.3 million. So that's a nice increase. We always want to see revenues increasing, just because that means you can provide potentially more services to residents, and also not have to rely on your, accumulated surplus and restricted surpluses. Your number one operating revenue generator is the user fees and sales of goods. That's partially inflated due to the, Peace River, Regional Waste Management Company. That's what, the consolidated numbers are in there. Your net municipal taxes increased slightly, $166,000 or 1.3%. I know tax rates decreased on average roughly 1%. Assessments went up roughly 3%. We met in the middle and got the slight increase in tax revenue. Your government transfers for operating increased roughly 1.1 million. That is directly related to those fire evacuation costs that we saw as a receivable. It's just the town paid money out, for the fire evacuation, now is being reimbursed by the MD. So again, overall revenue increased 1.4 million or roughly 4%. That's good to see. Take a look at the graph here just to illustrate it. So the green bar is 2025, blue bar is 2024, and then the line is the budget, just so you can see how things are kind of in line. As you can see, your user fees and sales of goods is slightly above the budget. That's primarily due to the waste company consolidation. But your municipal taxes are in line. Your government transfers for operating was above budget, but again, that was due to those fire evacuation costs that the town is being reimbursed for. You guys didn't budget to being reimbursed 1.2 million, but you didn't budget to spend 1.2 million either. So at the end of the day, that is a wash. It's just an in and an out, but we have to recognize the revenue and expenses. But yeah, overall, everything's nicely in line from what we saw, and we were happy to see the slight growth in bookings. Taking a look at what the town has paid now, so the expenses by function. So we'll do expenses by function and expenses by object. We'll do it by function first. So transportation services, that's your roads, stuff like that. Your airport, anything related to transportation gets recorded there. Your protective services related to fire, policing, parks and rec. Pretty self-explanatory, as are the rest, I feel like, but that's kind of where the difference is between the function and the object, as we'll see shortly. Overall, your expenses did increase roughly 10% from 31 million to 34 million. So they did increase higher than your revenues, but again, there were some one-time items there. Your transportation services, the number right at the top, your biggest cost increased $500,000 from 6.2 million to almost 6.8. I know there's a big snowstorm here in December because we came up here in January and the town was still dealing with it. So the bulk of that increase is due to additional snow removal and hauling costs. Your protective services number went from 4.2 million to just over 6 million. Looks a lot worse than it is. It increased 1.8 million, from, the 4.2 to the 6. But again, those were the fire costs of 1.1 million. So out of that 1.8 million, you can pull out 1.1. Now there's $700,000 to explain. And that was due to, there was a community peace officer position filled and higher policing costs from the province. That's something that we've seen throughout all municipalities. The policing costs have increased huge and continue to increase. So that's something to be aware of, that your protective services expense is going to continue to rise. Looking down now, the next big increase was waste management, went from 2.6 million to 3. That is due to higher Peace Regional Waste Manager or Peace River Regional Waste Management Company expenses. And yeah, overall your expenses did increase, but there were some unusual items there, and some of them are outside of your control, like the waste company. We'll do the same fancy graph here, so you can see your expenses by function. We take out amortization and accretion expense, just because those are non-cash expenses. Accretion is related to the increase in your asset retirement obligations. Because these are just accounting transactions, we don't like to skew numbers with those, especially because sometimes amortization is not budgeted for. So then all of a sudden, all of your expenses are above budget, and we just say, oh, it's due to amortization, and that's it, right? We don't think that's very useful. So again, your transportation, looking at the far left, your transportation services came in under budget. That was due to just lower salaries. Your protective services there, you can see it significantly higher than last year and higher than budget, again, due to the fire evacuation costs. That was a one-time thing, or hopefully a one-time thing. Your water supply and distribution, the fourth column's there. Lower expenses, the decrease in budget was due to lower expenses. You guys do some transactions for internal tracking purposes, which we reverse for the financial statements, just because we can't create revenue and expenses from the town. We just like to have everything net to zero. But overall, the remaining expenses look very in line with prior year and budget. Nothing alarming there. So we will take a look at the expenses by object. So this is the difference between the expenses by object and expenses by function. Expenses by function kind of shows the groupings of everything can be included in there, but it's just a specific services. So protective services, for instance, right? Where now we're showing the expenses by object, so we can see how much you guys paid in salaries and wages and contracted services, materials, goods and supplies, that sort of stuff. We think this is beneficial too, just because then you can see how much you're spending in certain areas. So the top expense is salaries, wages, and benefits. People are expensive. I think everyone knows that. So those increased roughly $780,000 or 8%. There's fewer vacancies, some cost of living adjustments, and then a significant increase in benefit costs. The next line item is contracted and general services from 7.6 million to 8.8 million, increased roughly 1.2 million or 15%. Again, those were higher RCMP costs and additional snow removal. Looking down at your other, it went from just over $1 million to just under 2 million. That was due to the fire evacuation costs. We stuck them all into other because those aren't a true reflection of what normal operating revenue or normal operating expenses that the town's going to incur. So we kind of just stick them in other just so it really stands out, so they're not buried anywhere either. Your interest on long-term debt decreased from 727,000 to 603,000, just due to the decrease in long-term debt and capital obligations under capital lease balances. So again, overall, the expenses are the exact same here, it's just a different presentation of how they're shown, but your expenses did increase roughly 10%. To your other income and expenditures, the town had an annual surplus of $900,000 before other income. The other income was government transfers for capital was the big one, which decreased slightly. There was fewer grants in the current year, though this was offset by larger local government transfers for capital projects. And then the gain loss on disposal of tangible capital assets. There was a piece of land that was sold in the current year, so there was a slight gain on that. So overall, the annual surplus this year was 3.6 million compared to 5.8 million last year. It was slightly lower, but it's still positive to see. That's good growth year over year for the town. So in summary, we provided a clean or unmodified audit opinion. That is the best sort of audit opinion we can issue. There were no significant findings, no unusual items, nothing that came to concern of ours that we thought would be relevant to share with council or management. Your net financial assets, it went from being in a debt position, as previously talked about, of almost $5 million to being in an asset position of $1 million. So that's a $6 million swing year over year. That's really good to see. Got me thinking, I wanted to check back to see what 2023's looked like. 2023, you were in a position of, I believe it was $11 million net financial debt. So 2 years, you have a $12 million swing from going from where if you sold all of your financial assets to pay your liabilities, you would have owed $12 million 2 years ago. This year, you still have $1 million cash. Obviously, you're not just going to sell all your financial assets and pay off all your obligations, but that is a very good improvement. I don't know if I've seen an entity your guys' size make a swing like that before. I've been doing this for 10 years, and I had to double check to make sure I wasn't seeing things. While you had a slightly lower surplus this year, overall things are really good. Keep going. This is a positive to see. And yeah, it makes, I know talking to the other accountants in the room, Barbara and Roxanne, we were pretty excited to show these statements because that's a big swing to make in 2 years. And especially if you look back, I think it was 3 years ago as we were talking, it was about $17 million debt, net financial debt position. So you guys are doing really well, and we want to keep seeing that. Thank you. Again, I'm Craig Bader, and I'll take any questions that you guys may have.
Any questions from the councillors?
Wow.
It's a very, very well done presentation. Thank you.
I was gonna say, if something doesn't pop up right now, if Roxanne and Barbara have my contact information, always reach out. I love talking about audits. But I'll still field any questions now. But yeah, if something pops up, don't hesitate to reach out. We're always around. So.
Okay, I don't see any questions at the moment, but we know where to find you. So thank you again. And that was really, really positive news.
Yeah, it is. It's good to see. I don't just talk up all my clients like that. It's genuinely good to see. So I'm very appreciative to be a part of this.
Thank you. Thank you.
Okay.
Okay, well, thank you very much for your presentation.
Thank you guys for having me.
Moving on to number 4, under current business, we have the adoption of the Town of Peace River 2025 consolidated financial statements with Ms. Gato.
Thank you, Madam Mayor and Council. Craig just went through a summary of the financial statements. So I'm not going to go through them page by page. I think everybody wants to be awake for the hockey game tonight, so. Anyhow, I'm going to trust that if you guys have any questions from what you read or from Craig's presentation, that you guys will let us know. So we have a couple of choices tonight. Option 1 is that council approves the 2025 audited financial statements, which would put us in compliance. Was that a question, Councillor Ford?
No,
you're waving.
Bye.
Okay, all right. Which would put us in compliance with the MGA. There are no disadvantages and no financial implications. The second option would be to decline to approve the 2025 audited financial statements as presented, to allow for further discussion. And under that option, we would need to seek an extension of the May 1st requirement from Municipal Affairs for reporting purposes. There are no advantages that we are aware of to that, and we would fail to meet MGA requirements. And it could have implications for our ability to borrow if we needed to do so. And we also have to submit financial statements to maintain our line of credit. So our recommendation is that council approve the 2025 consolidated financial statements as presented and attached in the package. Any questions?
Are there any questions for Ms. Gato? Go ahead, Councillor Deuce.
Just one question. I noticed on here, with our debt servicing, we pay a little over $600,000 in interest. Is there any opportunity to use some of our cash reserves to pay down the debt to save money on interest? Or I know not all debt is bad, but
Not all debt is bad. At this point, we would have to evaluate. We did do that a year ago, I want to say, where we paid out high interest leases. Most of our debt is 5% or less, which is actually a very low rate.
I'll just add to that, Alberta Capital Financing, most of our debt is Alberta Capital Financing, and it's
Debentures.
nearly impossible to buy.
interest, yeah, okay,
Yeah,
thank
But
you.
if we're only paying 1.4 and we can right now invest in longer term, then we're actually still making.
yeah.
Okay, thanks. It was just a question about the interest.
Mhm.
Thank you.
Any other questions? Will someone entertain a motion? Councillor Deuce.
I would move that council approve the audited 2025 consolidated financial statements as presented and attached here to forming part of these minutes.
All those in favor of the motion? And that is carried. Thank you, Ms. Gato. And we are now going to be entering into a closed session. And we will not be returning after the closed session, so we will be done for the evening till the next. Thank you.